Hello YouTube. I didn't expect to make another video today. I felt the first one pretty much had all the important news stories of the day in it, so this is more of a fluff video. I just found this article and I wanted to briefly tell you guys about it, read it with you, talk about it, because I think it makes some pretty good points, especially for crypto newbies, and some good arguments that you should keep in mind for investing in general, but I don't fully agree with every part of it. So let's just quickly take a look at it. It's on cryptonews.com and it is called 6 Commandments for Crypto Investing. It is written by Juan Villaverde, I hope I pronounced that correctly, an econometrician and mathematician devoted to the analysis of cryptocurrencies since 2012. He heads the Weiss ratings team of analysts and computer programmers who created Weiss cryptocurrency ratings. Now, if you're not familiar with Weiss, they have been in the news a lot. They give ratings to all the major cryptocurrencies, to all the tokens, and they're applying similar standards to the traditional financial ratings, like how stocks and bonds and countries usually have a rating that starts at AAA and then goes down the letter grades, about how secure an investment it is, how safe it is, how good the technology is, all that stuff. And they are doing that for crypto, and this is the leader of the analyst team, and he gives some general crypto investment advice that I think anyone should pay attention to. So let's read the article together. The takeaway from my previous article, 5 Myths of Crypto Market Manipulation, is that the game is not rigged. Beyond a few obvious pump and dump schemes that can be spotted from a mile away, the best defense for small investors is to trade smart and above all prudently. And in the long run, the reason why large institutional investors are successful is that they stick to sound investing principles. They have a plan. This is what helps maximize the chances of success over the long term, whether they are whale or small fry. If you want to do the same, here are 6 crypto investing or commandments to adhere to. Now, I think he's more or less on point with this previous part, the game not being rigged. Certainly, some manipulation is going on, as there is in all markets, especially in young markets. But as a whole, pretty much everything that is happening can be explained through other reasons. Most of it is really just investors getting scared, getting confident, pushing money in, pulling money out. Like, most of it does not appear to be rigged. There does not appear to be too much insider trading, at least not compared to other financial markets. Which doesn't mean there's none, which doesn't mean nothing is ever rigged, but as a whole, the markets do not seem to be rigged. There are definitely attempts, and there are individual schemes, but not in general. Now let's look at his 6 commandments. Number 1. Recognize the risk. Never lose sight of the fact that crypto is still an immature, high-risk asset class. Several coins that we rate merit high technology marks. Also, a handful have enjoyed broad adoption. But currently, not a single coin merits good scores for investment risk. Nearly all are weak or very weak in that category. This is one of the key reasons Bitcoin currently gets a Weiss rating of C+. It's also why no coin gets an A. Now, investment risk is all about volatility. It should be obvious why cryptos don't currently get good scores on that. Because, of course, anything that drops between 70 and 95% in under a year is highly volatile. And also day to day, cryptos have a lot more movement than, say, stocks usually do. And it's often harder to explain why cryptos are moving. When you see shots shoot up or shoot down, there's usually a very good reason. There's a piece of good or bad news. Here, not necessarily. So number 1, I am all on board with that point. Recognize that this is a risky investment. That means potentially insanely high returns, but there's also the very real potential that you can lose much or even all of your money, and you should always keep that in mind. That is why rule number 1 is always, for me, never invest more than you can risk losing. If anything you have invested, if it all disappeared tomorrow, it's fine to be sad. It can be tragic, but your life shouldn't be ruined by it. You should still have all the money you need. You shouldn't be in debt after you lose all your investments. And that, for me, is very important. You need to have enough money set to the side in safe investments that when something as highly volatile as cryptos do implode, which I don't believe is likely, but is certainly possible, that you're not going to be ruined by it. Number 2, don't get sucked into a buying frenzy. The worst time to buy is when big crowds are trying to do the same. This is why we strongly advised our friends not to buy Bitcoin near its peak in December 2017, and it's another reason we gave it a C+ rating when nearly everyone in crypto land was screaming buy, buy, buy. Wait for the frenzy to calm down, or better yet, wait for the inevitable bear to follow the bull. Another good point, another very basic investing point, but a lot of people are not keeping it in mind. You never want to buy when the market is strong, you always want to buy when it's weak. That applies to anything. You want to buy when it's low and you want to sell when it's high. And when everyone is pushing the price high, when you're in a bear market, in a bull market, you don't know exactly how high it will take you. It's possible that you're buying early in it, but there's a very high chance that you're going to make more money if you're buying when it's a bear market, when the price is low. So make sure to buy during those times and not during the peak. Never buy at the peak of the price. If a coin you like has just gained 500%, don't buy. Wait. Just wait. There's some individual cases where it will raise even higher, but usually these increases are followed by a bear market, are followed by drops, and you should be buying during those drops as close to the bottom as you possibly can. Like I said, very basic advice, but very important to keep in mind, and it's good to have an article like this that has it all in a short little list. The link will of course be in the description too, so make sure to also check it out. Number 3. Don't commit more funds than you can afford to lose. This of course something I just said. This may sound obvious, but many novice investors choose to ignore it. Their decision seems to be predicated on the belief that they know ahead of time what the market will do next. But if that were the case, why not just mortgage the house, sell the family silver, and put all available money into the asset? Now, of course, being satirical here, don't do this. Dedicate no more than 5% of your liquid assets to crypto. We have just half of that 5% deployed in our Weiss cryptocurrency portfolio service right now as we await the next buying opportunity. The reality is that no one can know with certainty what the future will bring. The best you can hope for is a well-educated guess. So it stands to reason that you shouldn't overcommit to any single asset class, let alone a risky one. As a general rule of thumb, we have continually recommended dedicating no more than 5% of liquid assets to crypto. And in our Weiss cryptocurrency portfolio service, we have invested only half of that money so far. With the other half, we're waiting patiently for two factors: big bargains and a signal from the market that a new bull phase has begun. We got the first, but haven't yet received confirmation on the second. I'm a bit more hopeful about the new bull phase having begun already, but aside from that, I more or less agree with this part. Now, don't commit more funds than you can afford to lose is very obvious and very true. I'm not sure about the 5% limit. Now, if they want to apply that limit, that is a very safe choice. If you want to play it very safe, that is good. I personally have a higher amount of liquid assets in crypto, and for me personally, I want to play it higher risk, which of course also means higher potential reward, but also that everything could be gone. Now, but 5% is a very, very safe number, and I believe for people who are not keeping up to date with all the news, who don't know the details of the projects they're involved in and of the markets, who don't understand the in and outs, and who are not in it for the long run, I think 5% is a good number. If crypto is just a small part of your investments, if you're not very well versed in it, I think sticking to 5% is good. If crypto is all you read all day, if you're keeping on top of all the news and all the new projects, then I think you can invest a bit more. Just be careful. Always be careful, and don't commit more than you can afford to lose. Number 4, never borrow money to trade crypto. Some high rollers seem to have no problem day trading their entire portfolio while using up to 20% leverage. That's the equivalent of about 5 cents on the dollar of your own capital and 95 cents on someone else's. Personally, I have always been more risk averse. I would rather make fewer profits for the sake of avoiding bigger losses. How do you know what's too risky for you? If you're losing sleep over your trades, you're overinvesting. Another telltale sign: if you can't take your eyes off the screen. Solution: cut your exposure. I'm generally against borrowing money to make investments, with some very rare exceptions, when you have absolute or near absolute certainty that your returns will be worth it. I think if you're borrowing, you're dealing with way too much risk, you're dealing with potential disaster. And I'm personally against that. Now, of course, if you want to do more risky investments, that is up to you. But general rule of thumb, I say don't borrow if you don't have to. Deal with the money you actually have, invest that safely, securely, and it is better to make 100,000 on a 10,000 investment than to put in 10,000 and 90,000 in leverage and then lose all of it. Even if you could potentially have made $1 million then, don't forget there is the chance that you'll lose everything. And if you lose someone else's money, that is not good. That is so not good. Number 5. Ignore the headlines. Reporters go with the flow. If the market is exuberant, you see mostly good news headlines. When the market is in dog days, all the pessimists come out of the woodwork and bad news headlines prevail. So following the headlines winds up being pretty much the same as following the crowd, buying high and selling low. Some prime examples. Right now, you hear a lot about Bitcoin not solving any real issues. That news is also dominated by scary stories about the government's power to make crypto disappear. The opposite was true when the market was flying high. All the talk was about how Bitcoin and other cryptos were destined to replace fiat money as the world's reserve currency. And insane predictions of stratospheric Bitcoin prices prevailed. In fact, news cycles are driven by price, not vice versa. His advice, ignore them. I am kind of with him here. I think you shouldn't be making your choices only from the headlines. And I think it's important to do more research than just looking at the top page of the news sites at the moment. I think you need to be fully aware of what each project you're involved in is doing, what their long-term plan is, and not just which good news came out that week. But on the other hand, it is important to keep up with the news coming out. You need to know what's happening. Just take it with some salt. Aside from that, I'm not sure about his statements here. This is an article from yesterday, and he's saying that right now we're only getting negative news about Bitcoin, and when the market was high, we got stratospheric Bitcoin price predictions. But the thing is, I have reported on multiple very high price predictions for Bitcoin that were in the news the last couple days. Certainly, the prices and general mood do drive news cycles, but not only. And it's good to be skeptical. It's good to never take anyone at their word. And if you're watching my videos, please also never take me at my word. Do your own research. I'm just talking about what I find interesting, reading news with you guys, giving my personal opinions. Not an expert, can't tell the future. Don't ever invest in something or pull out of something because I'm telling you to. Just keep my opinion in mind maybe as one of many. And number 6, buy the best technology and adoption. And this one I think is really, really, really good and important. My rule is you buy the best product, not the most hyped product, not the product doing best at the current moment, the product that is objectively as good as possible. That means you look at the technology, you see which projects have impressive tech behind it, which have a good team, which have legitimacy, which have real use cases, which have adoption, which have good associations with companies and associations, countries outside of crypto, outside of the crypto sphere. You look at all those things, and you don't just look at the price and the market volume. That way you will fall for pump and dump coins, you will fall for hype coins that don't do anything, and that is very dangerous. But let's actually read this. These are the 2 factors that will prevail over the long haul. Right now, for example, 2 of the coins that score high in terms of adoption are Bitcoin and Ethereum. Plus 2 that are among the highest rated in terms of technology are EOS and Cardano. What's the bottom line? It's true that wealthy investors are likely to emerge from this consolidation period reaping the greatest benefits. But it's not because they tricked the small fry into relinquishing their positions. Quite the contrary, small investors have jumped, almost salmon-like, straight into the tendered nets of their own impatience. This is important. Don't look at what is doing great right now. Look at what has the potential to do really great in the long term. What about the notion that the ocean is only big enough for the whales? Let me remind you that most cryptocurrencies are now trading at levels unseen since the beginning of 2017. Are small investors buying? Nope, they are swimming for the exits. This is what I was saying earlier. We are in a bear market right now. This is the time to buy. Don't wait for the prices to go 5-fold up. You will be losing money the next time they fall again. Buy while they're low, buy while they're as low as possible, and wait. You have to understand that patience is sometimes key. Bottom line, don't fall for promises of easy gains only to find that they have been sold a pup. There's no entry in the trader's dictionary under easy. However, it's not difficult to stick to sound investing principles. All that requires is a bit of discipline. Now, as you heard, I don't agree with him on every point or completely. but I still think this is a very good general article, and these are things to keep in mind, both as a crypto newbie, or just to remember once in a while if you've been in the markets for a while, and these apply to all investments. So this is a very good article. The link will be in my description. Let me know what you guys think about this. Are there any of these 6 rules you completely disagree with? Do you think there's a rule missing that maybe should have been added? Yeah, let me know, and thanks so much for watching. I will be back talking about the news probably tomorrow. See you guys then.